Good afternoon and welcome to our online seminar on Emergency Liquidity Assistance in the Eurosystem. My name is Pierre Schlosser. I'm the Scientific Coordinator of the Florence School of Banking and Finance, and it's a real pleasure, as always, for me to welcome you all to today's online seminar. I think it's fair to say that Emergency Liquidity Assistance is an absolutely fascinating topic. One may argue that it is one of the unfinished business of the European Monetary Union, and this has become particularly obvious ever since the banking supervision function was uploaded to the central level. To discuss this today in depth and in more detail, I'm very glad to be in the company of Professor Christos Gortsos, our lead speaker of today, and of Professor Vítor Constâncio, today's commentator. Welcome to both of you. Before entering into the fascinating discussion, I would like to inform you a bit more about our school's upcoming activities in just a few minutes, really. As some of you already know, a key line of activity at our school are our residential training courses, and you will see on the slide who typically attends them. You will notice that since the school's creation in January 2016, and we celebrated the 4 years existence of the school very recently, we have trained more than 2,500 participants coming from 75 countries. Of course, you can find more details on all our activities on our website, but let me just flag 3 courses which could be of interest to you. In a few weeks' time, we'll have a course on residential course on monetary policy transmission. We'll look at banks, but also at non-banks, at credit and at prudential policies, together with Carlo Altavilla from the European Central Bank, and together with José Luis Pedro from Imperial College London. The course will then be also followed by a seminar with Massimo Rostagno from the European Central Bank and with Luis Garicano from the European Parliament. Then later in March, we'll have a course on liquidity regulation practice and stress testing with Professor Gortsos, as well as practitioners from both policy making and industry. And the purpose of this course really is to analyze the framework governing the prudential regulation of liquidity of credit institutions in the EU and provide also practical illustrations. Lastly, in April, we'll have a macroeconomic course with Nobu Kiyotaki from Princeton University on liquidity and public policies. And I invite you to have a look at our website where you can find more details if you're interested in this course. Perhaps even more importantly, I'm very glad to announce that in mid-May, we will host a 2 weeks online course on securitization. You could see the video, some of you at least could. It's a new feature of our training offer, and we'll be glad actually to show that in this occasion. I'd like to thank you for your patience at this stage and would like to introduce you to one another. Who are you? Where do you come from? So there are about 70 participants connected today following us from several European countries, but also other continents. 32 nationalities are represented, to be specific. We're very glad to count on several participants from both the public and the private sector today, and from about several participants also from the SRB. 40% of you are women, 60% of you are men, and you have on average 8.4 years of professional experience. This time, about half of you are trained economists, 27% are trained lawyers, but we also have other profiles in the group today. Lastly, 78% of you have a master's degree, while 50% of you have a PhD and 7% have a bachelor degree. So with no further ado, let me hand over now to Christos, who will share his views on the LA for about 20 to 22 minutes. His intervention will then be followed by Vítor Constâncio's remark for about 7 to 10 minutes, and Christos will then have a chance to react before we open up for the Q&A, where you will have a chance to write your questions and we will engage with your questions. So let me stop here now and leave the floor to Christos.
Thank you very much. Good morning to everyone, ladies and gentlemen. I'm very glad to have been invited in this online seminar, and I'm really honored that Mr. Constâncio, Professor Constâncio, my colleague, has accepted to be a discussant on an issue which is very important and is still unsettled to a certain extent, to the extent that we have already in place the ELA mechanism. It is in place since the beginning of the monetary union, but still there are discussions on whether the ECB should have more powers in regard to the operation of this mechanism. And that's the reason why the title of my presentation has been kind of provoking in the sense that I said potentially the ECB might be responsible at least for a subset of credit institutions operating in the Eurosystem, in the Euro area, in the Eurozone, those which are directly being supervised by the ECB, to be also responsible itself to providing liquidity assistance in case of emergency. But one at a time. I have structured my presentation in three parts. I would like briefly to introduce the main subject, which is lending of last resort, because we will see that the building blocks of the theoretical approach are all being applied in the case of the ELA mechanism. Then briefly discuss what I have developed here in my slides. It's more extensive about how the current system works on the basis of an agreement of the ECB of 2017. I will present that as briefly as possible, and then speak about a potential revision of the existing ELA mechanism. I know this is a controversial issue, but again, the online seminars are for that. And not a topic, an aspect which I'm not going to discuss today, but which is closely linked to this, is liquidity in a resolution. And I have seen the slides before, and I realize that we have a lot of participants from the SRB and potentially also from national resolution authorities. This is an additional thorny issue. Who should provide liquidity? Not in a resolution, as a matter of fact, the day after the resolution action has been taken. This is another very important and very much disputed issue, whether it should be the SRF, any national funding arrangement, whether it should be central banks, and if it is central banks, which central bank, the ECB or the national central banks. So again, this is a very closely linked issue to what we are going to discuss today, but not the one I'm going to develop more. I know that the school has spent some time in discussing this in a previous seminar, and potentially we can have that in the future. I have some problems in seeing my slides, but yeah, now I have it. Now, last resort lending is the provision of liquidity by a monetary authority, that means central bank, to individual solvent banks in exceptional circumstances and on a temporary basis. And this power is typically associated with central banks because there are synergies between the provision of liquidity to the banking system, safeguarding stability both in payment systems and in the financial system. And of course, it highlights the close relationship existing between the financial system, including payment systems, and the monetary system. Let me briefly state that the term lending of last resort is also used sometimes on another function, which is totally unrelated to what we are discussing today, the provision of financial support to states. And this is not a function of central banks. Lending of last resort to states, to sovereign states, is at the international level work of the IMF, and at the EU level anymore, a work of the ESM. Now, last resort lending must be distinguished from monetary policy and from solvency crisis management measures. In the case of a bank becoming insolvent, you have other measures that can be taken. Today, very important, the resolution of these credit institutions, and potentially they're winding up depending on the case and the assessment made by the resolution authorities. But this is totally different from the case of the provision of lending of last resort, which is typically the case when you have a liquidity crisis, and it is a liquidity crisis management measure rather than a solvency one. And then it has to be distinguished from monetary policy measures for several reasons. The one being that in this particular case, you provide liquidity to individual credit institutions exposed to the to liquidity risk and not to the entire banking system, even though the case may be that several banks, if not all banks in a system, might face liquidity strains under certain conditions. I can only remember, as an example, the case in the Greek banking sector in 2015. But in principle, liquidity assistance, emergency liquidity assistance, lending of last resort is provided to individual banks and not to the entire banking system, and definitely not on the same conditions as those in monetary policy. And then two additional points are here very important, that in principle, because you have exceptions in history, a bank solvency is a prerequisite for providing lending of last resort. We will see that also in the case of the ELA. And last resort lending is provided against adequate collateral and at interest rates which are typically much higher than those of monetary policy operations for several reasons. The one, in order to prevent some kind of moral hazard, and the second, depending also on the quality of the collateral which is provided in these cases. Now, another very important issue is the aspect of constructive ambiguity, meaning that typically you do not have specific conditions set in law which prescribe under what conditions the central banks, the monetary authorities would provide liquidity in terms of last resort lending. This is reflected in the fact that you don't have legislation on the ELA, you don't have legislation on the provision of liquidity in any jurisdiction. It may be provided, which is not the case in our treaties, in the treaties on the functioning of the European Union and the smaller treaty with regard to the role of the ECB or the national central banks, but usually you do not have it in any constitutional or legislative act. You may have a provision that the central bank is providing lending of last resort, but the conditions are not set on legal instruments. This is giving central banks the floor for some discretion on the conditions under which they will operate in this particular case. Now, going over to the European Union, the Eurosystem Framework, from the beginning, I can remember that from the beginning of from the early 90s, there was a discussion who would be the lender of last resort for the banks in the member states which would join the monetary union. And even until today, we have opened this discussion, who is providing that. There were two theories, there were two approaches in this respect. The decentralized approach, according to which it would be the national central banks which would provide that. On the other hand, there was an approach stipulating that it should be the ECB which should provide this lending of last resort. Let me note from the very beginning that the Treaty on the Functioning of the European Union is silent on this. And as a matter of fact, the decentralized approach has been adopted up to now and is the one which is still prevailing. We didn't have any legislation on this, as I mentioned before. We didn't have any provisions in the treaty, as I said before. We didn't even have any formal ECB text on this, or even an informal, until 2013, when the ECB decided to make its procedural arrangements public, and then it issued a new communication in February 2014, which has been slightly revised, and currently we have the so-called ECB Agreement of 2017, which is setting the procedural arrangements with regard to the provision of the ELA. You may recall that the ELA has been made resort to by several banks in several countries during the recent or the ongoing, I don't know how you want to define it, fiscal crisis in the euro area. It was the case in Ireland, it was the case in my country, in Greece, twice. It was the case in Cyprus, in Portugal, and potentially in some other cases on a more sporadic cases. But definitively, resort to the ILA mechanism has been made by several banks during the current or the ongoing or the recent fiscal crisis by all countries which were most severely affected, hit by that crisis. I wish, can you please move on to the next slide? Because thank you very much. The main elements of this ECB agreement, the main arrangements of the procedural steps taken by the national central banks and the ECB are the following. The first one, the ILA must be in compliance with the prohibition of monetary financing, which is laid down in the treaty. A second element, which is very important, is that this is written down in the ECB agreement that credit institutions established in the euro area member states can draw liquidity in two different ways, in two different manners, either in the context of the monetary policy operations or in exceptional circumstances through the ELA. And the agreement defines exactly how the ELA is operating. And then the provision of ELA is not considered to be part of the single monetary policy in the euro area. This is totally consistent with the general provisions. Can you please move on to the next slide? Unfortunately, my stick does not work. Yeah. Now, as mentioned before, the provision of ELA is the main responsibility of the national central banks concerned. So it is at the beginning at the discretion of the national central banks to provide this liquidity assistance under the condition, nevertheless, that the ECB has not prohibited that. And I'll come back to this further when discussing a specific article in the statute of the treaty, which is keeping the balance between the actions between the national central banks and the ECB. And as a byproduct of the previous arrangement, the fact that the national central bank concerned incurs any cost and risk that may arise from the provision of ELA, and the relevant funds appear on its balance sheet, even though they also appear in the consolidated accounts which the ECB is setting up for the Eurosystem according to a specific provision of the statute. Now, a very important element in this discussion is Article 14, Paragraph 4 of the Statute of the European System of Central Banks of the ECB, which is setting out in very briefly the following. To the extent that the national central banks are providing services which are not contradicting in principle with the tasks, the basic tasks which have been assigned to the ECB according to Article 127, Paragraph 2 of the treaty, they can continue to do so, provided nevertheless that the ECB is not objecting to this according to a formal procedure which is being followed involving the Executive Committee and at the end the Governing Council with a majority of 2/3 of the votes cast. That means that in any case, it is the national central banks which take the initiative, but the ECB is not excluded from the whole process. And it is at that point in which I mentioned at the beginning in the headline, in the heading of my presentation, the still limited role of the ECB. The ECB does have a role, a very important one. One could envisage, and I belong to those, that it would have a more enhanced role with regard to this. Now, I don't think that I should spend much more time on giving the very details of the different conditions. There are within the ECB agreement some provisions with regard to the duration and the pricing of the ELA, very specific ones. The main framework containing the obligations that the credit institutions which are seeking for lending of last resort and taking the last resort have to meet the provision of a funding plan, meeting specific regulatory capital ratios and the leverage ratio, because as I said in the beginning, it is the ELA mechanism is provided is only to solvent credit institutions. And then you have specific rules with regard to the size of the ELA operations exceeding specific thresholds. The thresholds having been set to 500 million euros and then to 2 billion euros. In each case, the procedure becomes heavier and involves the executive committee and the executive board and the governing council of the ECB to a higher extent. And then you have some, if we can move on, please, to the next slides. You have specific rules with regard to the communication on ELA. The national central banks are allowed to make generalized communication on the provision of ELA, but under certain restrictions and conditions. Let me conclude with a proposal that several academics and practitioners have made before myself. If we can move to the next slide, please. With regard to the centralization of the existing ELA mechanism, I belong to those who believe that the ELA could definitively become the fourth pillar of the banking union. And in this case, this would require that the ECB would be responsible directly for the provision of liquidity assistance to credit institutions. And in any case, I would differentiate between the provision of ELA, credit institutions which are directly being supervised by the ECB. And my case is that this particular, for this particular subgroup of credit institutions, it is the ECB which in the future could become the lender of last resort directly as well. And then the ELA mechanism as enforced could be confined to the less important, less significant, according to the terminology of the SSM regulation, to the credit institutions which are directly being supervised by the national competent authorities. I understand the restrictions to this approach. I understand there are two main restrictions. The one is that the system has been operating smoothly up to now. It has been tested several times, and potentially a well-functioning system might not be necessary to change. A second might be whether there is a solid legal basis with regard to the ECB assuming this role. This discussion is much more contestable, but I don't think that we should spend more time in an online seminar to discuss about legal aspects. I have written on this, several other people have defended the same point, and we can have that in the Q&A session. Let me briefly conclude by repeating what I mentioned at the beginning. Closely linked to the ELA is also the functioning of the national central banks or the ECB as the provider of liquidity on the day or the days or the weeks after resolution action has been taken. This is a very acute issue. It is still contestable whether, as a matter of fact, it is the funding, the resolution funding arrangements which should take this role, or the central bank or a combination. But in any case, this is outside our presentation today. I can conclude here, and I will be very much waiting for the reaction of Professor Constâncio. Thank you very much for your attention.
Thank you very much. Thank you, Christos. So Vítor is connecting. Perfect. The floor is yours, Vítor.
And thank you to Professor Gortsos for his very detailed presentation of the whole mechanisms of ELA and the legal framework. Indeed, as he remarked, ELA is not foreseen at all in the treaty or in the statutes of the ECB. And well, there may be reasons for that if we think that also in Germany the Bundesbank had no competence in these areas. So lender of last resort in the sense of providing liquidity to banks with the needs of liquidity was not foreseen in the legal German system, and it was then not in the treaty and not in the statutes. But of course, as also Professor Gortsos explained, this has been a long-standing function of central banks over more than a century. And so immediately after the creation of the Monetary Union and the ECB, there was in the Governing Council the recognition that this mechanism had to exist. And to exist, it could only exist under the article of the statutes 14.4, as also Professor Gortsos explained, as some other task that would be performed by national central banks unless the Governing Council would consider that it was against the objectives and functions of the ECB. And the reason there would of course be linked with monetary policy, and that was also the reason why in Germany this didn't exist, because the provision of liquidity could interfere with the size of the monetary base, and monetary aggregates, as you know, were very closely followed in Germany then. So that would be the reason. So only under that article. And nevertheless, it was considered that it would be necessary to have an agreement among the members of the Governing Council, meaning the national governors plus the executive board, defining a framework for the provision of ELA. And the main thing in the first agreement, which was already signed in 1999 at the beginning, although disclosed only later in 13, as it was mentioned, but the main thing there was the condition that the banks had to be solvent in order to be granted this emergency liquidity. It had to be a pure liquidity problem and not a solvency problem, and the reason being that if it is a solvency problem, that then should be a task for ministries of finance to possibly deal with the matter, and not for the central bank, which should only be involved in pure liquidity provision. So that was then the context and the main condition at that time in what regards the provision of ELA. Then ELA became even more necessary after 2005. Why? Because in 2005 there was a decision to introduce a minimum rating of a country for its banks to have access to normal monetary operations, to have access to central bank liquidity with collateral. And then, since then, if a country is below that threshold rating, then the banks cannot exceed normal provision of liquidity. That was a meaningful decision, I'm not commenting more on that. Initially, it was defined as A minus. Every country at that time had more than A minus, so no problems in 2005. But then, of course, the crisis came, and several countries then had ratings below A minus. So in 2008, this was reduced to BBB, meaning investment grade. And even that, some countries, few, went below BBB. And then the Governing Council, in order to provide liquidity, decided that if a country is below the threshold, but nevertheless has a adjustment program with the ESM, as it was then created, then again it could exceed normal monetary operations, and if no program, then only ELA would be available. So ELA became more necessary because without that, if a country had no rating and no program, would not have a central bank if there wouldn't be ELA there. And indeed, ELA during the crisis was a very flexible and useful instrument to cope with many liquidity problems in banks that history proves afterwards could recover and are still operating nowadays after, in many cases, provision of capital by public money, either of the different member countries. So ELA became more necessary. Another point is that ELA, in spite of being then responsibility of NCBs, of national central banks, meaning the liquidity is then a liability in the balance sheet of the national central banks, nevertheless, because of the possibility of the Governing Council objecting, the Governing Council, especially when the crisis came in 07-08, became more and more demanding in terms of the conditions for the provision of ELA. And what I mean by that, and that is clear if one reads the second agreement, which then was published in 2017, we see that the system is in the end already very centralized, in the sense that when ELA becomes significant in terms of amounts, then the Governing Council, the Executive Board and the Governing Council are indeed in charge. And you may recall, everyone recalls that during a long period of time, and in the more recent years, in the case of Greece in particular, in many meetings of the Governing Council, there was this decision to prolong ELA, to define a ceiling for ELA, and besides the ceiling, there was also a list of things that the country had to, the central bank of the country had to provide the Governing Council in order for a non-objection decision to be made. So many controls, flow of information, and very strict coordination of the process in terms of the conditions and the flow of information. Now, it is true, as Professor Gortsos reminded us, that after 2014, the ECB got inside the ECB, although with firewalls, the single supervisory mechanism, the ESSM, and then the responsibility of supervising banks, which then is responsible in terms of the significant banks for assessing the conditions of solvency of those banks. So to many people it seemed perhaps logical, and it is logic, that in those circumstances the then not only the function, because the function, as I said, is already in practice very centralized, but just in terms of the liability, where would lie the liability of the ELA? That would be the thing in question. That this liability should also then go for the Eurosystem as a whole, meaning all countries would share the liability of ELA. There are two problems there in my view. I don't see that it is possible, that transfer. In the first place, there is a legal problem, because Article 14.4, after saying that national central banks can do other tasks, and that's where then, by definition, because it's not in the treaty anywhere else, where ELA then has to be legally grounded, these tasks of central banks, which can be objected, the Article 14.4 says, such functions shall be performed on the responsibility and liability of national central banks, and shall not be regarded as being part of the functions of the European system of central banks. So it's very clear that Article 14.4, which is the only one that could be used to give some legal grounds to ELA, says clearly that function cannot, must be a liability of the national central banks. So only a treaty change could really open the possibility of that transfer, and a very difficult treaty change in this respect, if you recall the origins of the fact that ELA was not foreseen at all in the treaty. There is also a practical reason, which is, of course, in terms of this attribution of liability where it lies, it's easier for ELA to be in the end approved if it is a liability of national central banks. And that was clear during the period of the crisis, particularly when ELA for some countries amounted to dozens of billions of euros. So one can understand that also if we think that in what regards QE, such an important measure of monetary policy that was indeed a big contribution to overcome the acute situation of crisis, QE was decided in terms that the purchases of national government bonds by the different national central banks is also a liability of the national central banks. In spite of being a monetary policy instrument, which ELA could be argued is not strictly a monetary policy, it's financial stability, but it's not within the main task of monetary policy. QE, which is also, it was necessary in the end, in a way, that the liability of the purchases would lie with national central banks, with the exception of the 8% purchased by the ECB and the exception of the 12% of European supranational issuers. So 80% is with national central banks' balance sheets. So this only illustrates that it is easier for this, and of course the legal obstacle is the more important one. So I would conclude by saying that that transfer to the Eurosystem, it's not legally possible and it's not advisable.
Thank you, Vítor. I think this gave us a very good starting point for our discussion. So I would invite Christos maybe to react to the extensive comments of Vítor, and then we would start with a Q&A. So while Christos, you have a chance to engage with Vítor's comments, I would also invite in parallel our participants to start thinking about the questions that they would like to raise.
Thank you very much, Pierre. That was very constructive on behalf of Professor Constâncio. And as a matter of fact, we have both touched upon the main issues concerning whether we can move a step ahead. Yeah, I would fully agree with him that if we envisage for a change of a treaty, it will take ages and potentially will not end up with a satisfactory result. So very briefly on the legal aspect, which may be extremely boring for the majority of the participants, I have a different view. I go from the assumption that Article 18, paragraph 1 of the statute could be used as an appropriate legal basis to the extent that it provides that the central bank may provide liquidity under adequate collateral. So this article has been designed, I know that, for open market operations, correct, and for other lending facilities under the monetary policy, but it is not excluded that it could also be used in the case of lending of last resort. So I fully agree that Article 14.4 would have to be used unless you can use Article 18 as a solid legal basis for the provision of liquidity assistance, and I understand that this is exactly the point where Vítor would disagree. Yeah. So it's a question on whether Article 18 would be sufficient or not. But let's not lose our time today, because the legal services will tell us whether it's working or not. Now, the second major issue is burden sharing. Yeah, we know that, and the burden sharing issue is also very important. So I can conclude with that and say that potentially there is a legal basis. The burden sharing issue is very important as well. The system is functioning well, so why change it? Yeah, this is a very legitimate aspect. But finally, I would fully agree that we should not wait for any treaty change, which nevertheless would give the opportunity, if and when this happens, to discuss about the general financial stability mandate of the ECB, which is still lacking in the treaty. But this is a more general discussion which goes well beyond what we are discussing today. Thank you very much, and thank you, Vítor, very much for your constructive remarks.
And to extend the scope and indeed engage with the topic of liquidity and resolution, liquidity in resolution that you had mentioned at the very start, if that is something that you'd like to tell us more about, and which Vítor might want to reply to.
Vítor, would you like to take the lead? Because I think I have covered that in the beginning. I do not believe that liquidity in the could, in principle, be provided to a very wide extent by the Single Resolution Fund. This is a huge discussion now, whether the SRF would have the capacity to do it, or whether under the provisions of the SRM regulation, it is even included in its mission. But again, this is open to interpretation. And now the power of the SRF, even after the fiscal backstop has been approved, to provide, in addition to the other funds it would provide, for example, for filling in the funding gap in the case of a resolution, or the capitalization of a bridge bank, which would be necessary. On top of that, providing liquidity, especially in the case that a bank has been resolved under the open bail-in scenario, meaning that the needs for liquidity would be huge, and especially if we take into account that a larger bank would be involved, not to mention two, I don't think that the funds of the SRF would be sufficient. So in this case, resort to liquidity should be by central banks. And here again, which central bank, the ECB or the national central banks? It's open again.
Yeah. May I say something on this very briefly?
Please. Of course.
Yes. So please. Indeed, first let me say that this question of liquidity in resolution will be a potentially rare thing, because what we are talking about is the situation where a bank is resolved in the famous weekend, and then on Monday faces the markets to get liquidity. And in many circumstances, of course, a bank that has been resolved is then well capitalized, recognized by the supervisor as being capitalized, may really go to the market and obtain normally the liquidity in the interbank market and so on. But there may be the case that it is not like that. Also, that bank being fully solvent after resolution also has access to regular monetary policy operations if it is in a country that has the sufficient rating, as I mentioned before. But it may be the case also that the bank has not enough collateral to go to regular monetary operations. So two conditions that already show that these cases may be rare in practice. That's an important thing. The second point is that, as we see from other countries and from experience, if this happens, we are talking about billions that would be immediately necessary, and only central banks can provide that, very readily. So I agree with Professor Gortsos that the SRF is not really the suitable institution, or any other institution which would have to have liquid, non-remunerated resources always readily available to use for that function in the billions. So, for instance, what happens in the case of the UK? In the case of the UK, there is a memorandum of understanding between the Treasury and the Central Bank, whereby the Central Bank provides the liquidity in resolution with the guarantee of the Treasury. So the Central Bank does not run any financial risk, but provides the liquidity. So I think that a similar arrangement should indeed exist in the euro area, by having the ESM providing a guarantee and the ECB providing the liquidity. The ESM represents the governments, is an intergovernmental institution. The board of the ESM are the finance ministers, so it's the equivalent of the UK Treasury in this scenario. So that is what I think would be the suitable and practical solution to that question.
May I add? The first is that anyone interested in the issue, there is a report by the Financial Stability Board of 2018 on this issue, which is an eye-opener, and which is exactly defining under what conditions liquidity might be needed, a resort to liquidity on the day after the resolution. And this would not, I agree with Vítor, this would not be the case as we have seen it now, when, for example, in the case of Banco Popular Español, the good part has been taken over by an existing bank, but potentially in the case that a large bank would be resolved under the open bail-in scenario. That means that it would be recapitalized, of course, but several depositors of this bank would have faced huge losses due to the conversion of their deposits over 100,000 euros into capital. So in this case, it cannot be excluded that some huge need, extensive need of resort to liquidity would appear. A second point of information is that this issue is being discussed also beyond the European Union, and I know that the Federal Reserve is expected to give some guidance early this year, meaning before July, before June. I saw it last week in the news that the Federal Reserve is also going to take a stance on this very thorny issue.
Okay, thank you. I think one aspect that you mentioned, Christos, in your presentation was also communication of national central banks on ELA, which I think there is some disparity, if I understood correctly, in Europe, and there was some controversy when the Bank of Greece published several decisions which I think have restrictions as to the level of details that they can involve. But would you like to comment on this aspect if you consider it to be of strategic importance?
Yes, this is a very important issue, and the fact that the ECB agreement contains at least half a page of details on this shows that it is not of minor importance. I think that the Bank of Greece has been very cautious in its communication policy because, as a matter of fact, you need in this case to balance two requirements. On the one hand, you need to ensure to the average depositor that banks can continue to operate, that they have the necessary liquidity. But on the other hand, you don't need to give so much detail which would threaten them. Because at the end of the day, the system needs to continue to operate smoothly as much as possible. So the communication policy is, in this case, an art. And in my view, having been in Greece in 2015, I remember that the ECB and the Bank of Greece mainly have been very cautious in their communication policy, despite the very heavy climate at that period of time.
Okay, very good. It's a very quiet day in the chat box today. Usually we have several questions. Perhaps it's an intimidating subject, but perhaps as a closing question, if I could invite both of you to reflect and to share your views on the collateral framework and the fact that I would assume the speed of granting ELA is dependent on the fast assessments of what of the eligible assets. So I think if you could discuss this with us, I believe that this was a dimension which was of relevance for case in Spain in the past.
Maybe, Vítor, you have a better understanding of this,
yes,
yeah?
The collateral is necessary, of course, even for ELA. And the quality of the collateral, if the liability lies with the National Central Bank, can be, let's say, assessed in a more relaxed way in comparison with the other scenario where the liability would be shared by all central banks. That's already one aspect that links to what I said before of being easier to have approval for ELA if the liability lies with the national central banks. Because in some stressful situations, precisely a bank in difficulty or liquidity difficulty already had used the better collateral to go to the market or to the ECB if he can go to the ECB, and if he needs ELA is indeed because the quality of the collateral is perhaps not to the same standard, but still acceptable for the National Central Bank and condoned or not objected by the Governing Council of the ECB. So that's a point which is important. One of the informations that the Governing Council has to receive is precisely in detail about the collateral that is being used for ELA. But again, if really in the present system, the national central banks and the Governing Council can be more relaxed if the collateral is not up to the highest standards.
Okay, thank you. Well, we can see that our participants have now some questions. So there is one question by Cornelia who is saying, as a conclusion, what could be the best solution to providing liquidity to banks before and after resolution? So I think that after I had the feeling that we had covered it before is something we may want to discuss. Antonio Spisu is asking, still on resolution actually, yeah. You mentioned that collaterals are needed in ELA. Would you envision the use of collaterals in the case of provision of liquidity in resolution? If yes, what collateral would realistically be available in such a situation? So I think that the two questions actually speak to each other.
Yes, of course. They are both very legitimate. I mean, as a matter of fact, the FSB paper, which I mentioned before, is touching upon the second issue, and I understand that people might be inclined to involve the SRF in the whole exercise just because they don't want to be faced with a situation in which no collateral would be available, which would be eligible for operations by central banks, because central banks are not allowed to provide any liquidity without any adequate collateral. So this might be a very tricky issue, and it's linked also to the first leg of the first question. What is the liquidity pattern, before resolution? This is a very tricky issue because before resolution, the bank will be resolved if the first condition is being met, meaning that the bank is failing or likely to fail, and then it has to be resolved and not to be closed down in terms of public interest. These conditions must be met. So who would provide liquidity to a bank which is very close to being determined by the central bank as failing or likely to fail? This is a very, very important question.
Thank you very much. Vítor?
What Christos just said, with which I agree. Before resolution, the bank is still operating normally and may indeed face matters of liquidity, because in practice banks come to a very stressful situation for reasons of liquidity, not directly for questions of solvency, although the doubts about solvency feed the liquidity stress, of course. But that's still at that stage a normal bank, that if it has collateral, can use it in the market, or after the declaration that the bank is failing or likely to fail, then of course the market or a central bank would not provide liquidity, because the bank has been declared not solvent or failing, obviously, and that's why it should be solved, if it is to be solved, under the conditions that were just mentioned. It should be solved in the famous weekend, very quickly, and then faces the after resolution situation, about which we have already talked about. If for liquidity in resolution collateral would be also asked, I don't think it's a practical issue, and not I think would not be suitable. Why? Because if the bank does not have enough good collateral to go to the market and do repos, or after being solved, or go to the central bank, it's because it has not good collateral. And so for the central bank to provide the liquidity, the condition is indeed a guarantee from the treasuries, as it is the case in the UK, and indirectly is also the case in the US, because in the US the FDIC is entitled to get a very sizable credit line from the treasury, many billions, that could be used also for that purpose, which is not the case in Europe. The conditions of then drawing on that are indeed under review, and there will be new framework about that. But also in the US there is this indirect mechanism, and that's what we lack in Europe. And although it's something that may occur very rarely, is nevertheless a weakness of the framework that we don't have this question sorted out.
Very good. Thanks. Thanks a lot. I can see that there is a last question, but unfortunately it's already 2 and 5 minutes. So I think that we will stop here. I'd like to thank both Christos and Vítor for their contributions. I'd like to thank our participants for their questions, and also, last but not least, thank Jan for all the preparation of the seminar. If you're interested in ELA, note that on the 23rd of April we'll have our annual conference here in Florence, where we'll touch on ELA in one session. We'll also discuss about other areas in which we consider that there is a gap in the financial union. So we'll look at anti-money laundering, and we'll look also at securities governance and regulation. And until then, there will be other occasions on the way, such as our course on liquidity, where we'll touch on very connected issues in March, also together with Christos and other practitioners.